Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time today.
Good afternoon.
Well, let's start with Wall Street, where the sell-off continued overnight, led by tech. It seems this could be something different from the brief spells of volatility we've seen more recently. The Nasdaq at one point was actually up quite a bit, but in the end was down 1.3%. What's the story in the global markets?
Yes, as you said, U.S. market did quite well in the earlier trading days, but towards the end, it showed quite sharp decline, and Nasdaq closed down by 1.3%. If you look at the overall decline from the peak in November, it is down by about 13%. And also Dow and S&P showed about 6% plus decline from recent peak in January. So overall, the market seems to be taking quite a bit of a concern over the interest rate rise. A lot of people are expecting that as March 16th, interest rate will be raised. Now I think the market is pricing in more than just a one-time rate hike in March, maybe even 0.5% rate hike. And some people are talking about 7 to 8 times rate hike over the next 1 year. If that happens, then the speed of the contraction on monetary policy is much more aggressive than previously anticipated, and therefore market seems to be quite cautious about this. However, though, if you look at the futures market, we did see quite a sharp drop at the beginning with the Netflix earnings coming out right after the close. Netflix going down by 20% in the pre-market, and that resulted into a huge decline of the futures market as well above 1.5%, but now has recovered somewhat as the interest rate rise seems to be easing out. If you look at the 10-year government bond rate of U.S., it has fallen down to now below 1.8%. So I guess everybody is looking at what's happening to the monetary policy. What we think, though, is that if you look at the government debt of U.S. as a percentage of GDP, that has reached as high as 130%, which is the highest level that we ever seen, even compared to the World War II era. So therefore, we don't think that the interest rate environment can be higher on that kind of size of debt. So therefore, we don't think the long-term end of the government bond rate is going to be rising that fast. And therefore, right now, we're seeing that rates coming down slightly. And we think that probably the highest level of the 10-year government bond rate would be somewhere around 2.5%. So yes, there is some more room for the rise, but nevertheless, we think that the current initial impact of the rising rate is going to be, it's been already priced in quite a bit. And we do think that with the FOMC meeting set next week, overall financial market instability should stabilize somewhat. We'll watch out carefully what the FOMC will be saying in terms of the rate hike and the speed of the monetary policy changes.
We will indeed. And today, Korean stocks down sharply as well, led by the big chip makers. Very few bright spots in the market today, though Kakao Pay was one of them. Retail investors buying a lot of shares today. Tell us about the domestic market.
Right. If you look at the overall Korean market, it did fall quite sharply. It was down by about 1% for Kospi, and Nasdaq is down by 1.65%. All in all, it seems that the foreign investors are major net sellers, continuously selling about 644 billion won worth of Korean equities. Actually, that was done by institutional investors, and foreign investors sold about 221 billion. The retailers are the only one that buying about 900 billion won worth of it. Also, if you look at Nasdaq, retailers were buying 380 billion, while the foreign investors were selling 320, institutions selling about 64 billion. So all in all, the institutions are selling quite heavily while local investors are buying. Why is that happening? If you look at the LG Energy Solution subscription, it was highly oversubscribed. The retail investors pumped in about 104 trillion won worth of money for the subscription. After that is done, some money is flowing into the equity market, buying some of the specific stocks. As you know, the Korean market has fallen quite a bit from the peak, well above 10% plus from the peak to bottom. The market's peak was about 3,300 plus, now 2,800. So that's about 15% plus decline from the peak. So we can do some kind of bottom fishing for some of the sectors. So obviously the Kakao would be one of the company that has shown quite a bit of decline in the past, and therefore some of the net buying is happening right now. All in all, the fundamentals of Korean economy seems to be quite reasonably okay with the export numbers and GDP growth rate and overall interest rate environment. So all being said, the current correction is a lot to do with the corporate governance issues, rate hike issues, and et cetera. So we think that there could be clearly some kind of bottom fishing opportunities that's rising right now.
Well, we also have a big story today, Mr. Yu, the cabinet approving this year's first extra budget, which will go to the National Assembly next week for a vote. It includes more payments for small business owners hit by the pandemic. It's worth about $12 billion, and most of it's going to be paid for by issuing debt, at least to start with. This is a concern in some quarters as rates rise. What do you make of the situation?
Well, if you compare the relative government debt to percentage of GDP, Korea is not that bad, or actually very good, in fact, in terms of the percentage. Government bonds or government debt as a percentage of GDP only amounts to less than 50% of GDP, whereas the U.S., as I told you earlier, it's about hitting 130%. Even China hitting about 70% plus. Obviously, European economy is hitting close to 100%. So all that means that the fundamentals of Korea is reasonably better. However, though, obviously, Korea is not a key currency economy, and therefore, unless they raise interest rate, we will not see foreign investors purchasing Korean assets that aggressively. And therefore, we're quite worried about how the interest rate environment would work out. All in all, I think that given the fact that the fundamentals of Korean economy is quite strong in terms of the manufacturing, and only concern is about the consumer debt level. So if the interest rate rises fast, then that could be a problem. So we will watch how interest rate will be moving. It's a good thing that the U.S. interest rate seems to be stabilizing, and if that's the case, then Korea's interest rate is not going to be rising that fast. Right now, we see that the 10-year government bond rate has fallen slightly, and it is hitting around 2.5% or so versus U.S. 1.8%. So there's still a gap, and therefore we don't think that the money outflow will be that significant. But in overall, we do need the boosting measures because if you look at the consumer segment, particularly the mom and pop shop, who got affected significantly from this COVID-19 event, they definitely need support in order to sustain their debt levels, interest repayment. Obviously, we need to see stabilization in regards to the COVID-19 cases, and that the with Corona era can come through, and therefore they can stabilize their cash flows. And obviously, this extra budget is something that was necessity rather than a concern.
Well, earlier you mentioned exports, and we do see that in the first 20 days of this month, they're up more than 20% from a year ago. On the other hand, they were outpaced by imports. So tell us about that and what you see happening in trade.
Yes, if you look at the export numbers, it grew 22% on year-on-year on the first 20 days of January. Clearly, that was driven by sharp rise of the semiconductor chip memory side. It was up about 29.5% year-on-year, and semiconductor accounts for about 20% of the overall export for South Korea. So clearly, the Samsung Electronics and SK Hynix are the ones that are doing well. And also, if you look at the export of petroleum products, it spiked 84%, clearly because of the global oil prices rise. So in terms of having a huge amount of deficit, yes, that is because of the import rising quite rapidly due to these energy prices. As you know, the inflation is happening global scale. and particularly the energy price inflation is quite significant, and obviously Korea imports everything in regards to the energy side. So that affects the overall the net export number, net trade surplus number. However, though, that's not a big a problem because as long as the export growth rate is at two-digit growth rate, and that Korea is very competitive in terms of various products, we don't think that that could be any massive problems in terms of getting foreign current account surpluses numbers. In terms of trade deficit, it is happening. However, the current account surpluses could be happening in the future as well. We do need to look at how the competitiveness of the other export areas are doing. One area that we were a bit concerned about was the auto place. But with the expectation of the electric cars supply to pick up from Korea, we think that overall export numbers should be reasonably okay going forward. Despite all the concern about the inflationary pressure, we do think that the global economy will be growing quite reasonably okay in terms of the nominal level. So therefore, Korea's overall growth rate should be reasonably good as well, given the fact that Korea is very dependent on the export side. So we'll watch out how that number plays out in the future. But overall, fundamentals of economy looks quite reasonable, and therefore we do think that the Korean market seems to be fairly cheap on the relative basis compared to the other countries.
Got it. All right, Mr. Yu, we'll leave it there for today. Thank you, as always, for sharing your insights with us, and have a great weekend.
Thank you. You too.